Did you just hear that? Silicon Valley Bank collapsed. Hello everyone, and welcome to this special report on the recent collapse of the Silicon Valley Bank. Silicon Valley Bank, also known as SVB, is a leading financial institution that specializes in serving technology and innovation-driven companies. It has been a key player in the growth and development of the tech industry for many years, providing financing, banking, and investment services to startups, venture capitalists, and other players in the ecosystem. However, in recent months, SVB has been facing a series of challenges that have ultimately led to its collapse. In this video, we will dive into the details of what happened, the causes of the collapse, and the implications for the tech industry and beyond. What happened? SVB's collapse came as a shock to many, especially given its reputation as a leading player in the tech industry. Let's take a closer look at the events that led up to the collapse. It all started when SVB's parent company, SVB Financial Group, reported a series of disappointing financial results. In its Q3 2022 earnings report, the company revealed that it had missed its revenue and profit targets and that its loan portfolio was underperforming. This news caused SVB's stock price to plummet, and investors began to worry about the bank's future prospects. As a result, many of SVB's clients began to withdraw the deposits and investments, causing a liquidity crisis for the bank. SVB tried to raise capital by selling off some of its assets, but this proved to be insufficient. Eventually, the bank was forced to file for bankruptcy, and its assets were seized by regulators. Causes of the collapse. Now that we know what happened, let's explore the underlying causes of SVB's collapse. There were several factors that contributed to the bank's downfall, including overexposure to the tech industry. SVB's business model was heavily focused on serving tech and innovation-driven companies. While this strategy had worked well for many years, it also meant that the bank was highly dependent on the tech industry's success. When the industry experienced a downturn, SVB was hit hard. Poor loan portfolio performance. As mentioned earlier, SVB's loan portfolio was underperforming, which meant that the bank was not generating as much revenue as it had projected. This was partly due to the fact that many of SVB's clients were startups that were not yet profitable, and therefore posed a higher risk for the bank. Lack of diversification. SVB was heavily reliant on a small number of key clients, many of whom were in the tech industry. This lack of diversification meant that the bank was vulnerable to any negative developments in the industry. Poor risk management. Finally, SVB's collapse was also due to poor risk management practices. The bank had taken on too much risk and had not adequately assessed the potential downside of its investments. Now let's talk about implications for the tech industry. The collapse of SVB has significant implications for the tech industry, which has long relied on the bank for financing and other services. Some of the key implications include disruption of financing. That means with SVB out of the picture, many startups and tech companies may find it harder to secure financing. SVB was known for its willingness to invest in early-stage companies, and its absence may make it harder for these companies to get off the ground. Regulatory response. The collapse of SVB has also led to a regulatory response from the government and other institutions. Regulators are currently investigating the causes of the collapse and looking for ways to prevent similar incidents in the future. Some of the measures being considered include stricter regulations on banks that specialize in serving the tech industry, more rigorous risk management requirements, and greater diversification of loan portfolios. The government may also provide additional support to startups and early-stage companies to ensure that they have access to the financing they need to grow. Impact on employees. The collapse of SVB has also had a significant impact on the bank's employees, many of whom have lost their jobs. SVB was known for its strong company culture and its commitment to its employees, and the collapse has come as a shock to many. Many former SVB employees are now struggling to find new jobs in the competitive tech industry. Some are considering starting their own companies, while others are exploring alternative career paths. The impact on employees is a reminder of the human cost of business failures and the need for companies to prioritize the well-being of their workers. Investor consequences. Investors in SVB have also been affected by the collapse. Many have seen their investments wiped out, while others are facing significant losses. The collapse of SVB serves as a reminder of the risks associated with investing in high-growth companies, particularly in the volatile tech industry. However, some investors may also see opportunities in the aftermath of the collapse. The tech industry is still growing rapidly, and there may be new opportunities for investors to find undervalued companies that are poised for success. Competitive landscape. The collapse of SVB also has implications for the competitive landscape in the tech industry. SVB was one of the leading players in the industry, and its absence may create opportunities for other banks and financial institutions to fill the gap. Other banks that specialize in serving the tech industry, such as Square, Goldman Sachs, and JP Morgan, may see an influx of new clients as a result of SVB's collapse. This may also lead to increased competition and innovation in the industry as a whole. Lessons learned. The collapse of SVB provides several important lessons for companies in the tech industry and beyond. Some of the key takeaways include: diversification is key. Companies that rely too heavily on a single industry or client are vulnerable to disruptions in that industry. Diversifying your client base and investment portfolio can help to mitigate this risk. Risk management is essential. Companies must have robust risk management practices in place to identify and manage potential risks. This includes conducting thorough due diligence on potential investments and continuously monitoring the performance of investments. Culture matters. A strong company culture can help to foster a sense of loyalty and commitment among employees, even during difficult times. Companies should prioritize creating a positive work environment and treating employees fairly and respectfully. In conclusion, the collapse of Silicon Valley Bank has had significant implications for the tech industry and beyond. It serves as a reminder of the risks associated with investing in high-growth companies and the importance of diversification and risk management. The collapse also highlights the human cost of business failures, with many former SVB employees struggling to find new jobs in the competitive tech industry. However, there may also be opportunities for investors and other companies to fill the gap left by SVB and contribute to the growth and development of the tech industry. In general, there are several lessons we can learn from the news of a bank collapse, such as: diversification is important. A company that relies too heavily on one industry or client is vulnerable to disruptions in that industry. Diversifying a client base and investment portfolio can help mitigate this risk. Risk management is essential. Companies should have robust risk management practices in place to identify and manage potential risks. This includes conducting thorough due diligence on potential investments and continuously monitoring the performance of investments. Culture matters. A strong company culture can help foster a sense of loyalty and commitment among employees, even during difficult times. Companies should prioritize creating a positive work environment and treating employees fairly and respectfully. The importance of regulation. Regulators play an important role in ensuring that banks and financial institutions operate in a safe and sound manner. Companies must adhere to regulations to maintain their financial health and protect customers and investors. The human cost of business failures. Business failures can have significant consequences for employees, investors, and the wider economy. Companies should prioritize the well-being of their employees and take steps to minimize the impact of business failures on them. Overall, it is important to remember that business failures are a natural part of the economic cycle. However, by learning from past mistakes and taking steps to mitigate risks, companies can improve the chances of success and minimize the impact of failures. Thank you for watching this video on Silicon Valley Bank. We hope you found the information useful and insightful. And if you have any comments, questions, or suggestions, please leave them in the comment section below. We love hearing from our viewers. Don't forget to like this video and share it with your friends and family who may benefit from this information. And as always, stay tuned for more valuable content coming soon. Thank you again for watching, and we'll see you in the next video.